All right, let's get right into it. Today, we're unpacking a source that makes a really explicit claim. It argues that a major market crash wasn't just a bad day for investors, but a deliberate, coordinated attack.
Everything revolves around this one number, minus 30%. The source we're looking at says that on January 30th, 2025, the price of silver just collapsed. And we're not talking about a small dip. We're talking a 30% free fall in a single day.
You know, the source video we're analyzing used this quote to really drive the point home. Their argument is simple. This wasn't normal market volatility. This wasn't even a correction. This, they say, was a total wipeout, engineered to cause as much damage as possible.
So what was the official story? Well, the mainstream financial world had an explanation ready to go. The narrative was that everyone was scared a new hawkish Fed chair would raise interest rates. That would make the dollar stronger, and a strong dollar usually pushes down commodity prices like silver. You know, a nice, neat, logical reason for what happened.
But here's where it gets interesting. The source we're examining just flat out calls that a cover story. It asks a pretty provocative question. Was this really just the market doing its thing, or was this something way more sinister? And that's the claim we're going to unpack.
So, the analysis presents what it literally calls a playbook for the attack. It highlights 4, let's say, highly suspicious events that it claims all went down at the exact same time, creating the absolute perfect storm for a market crash.
Okay, so check this out. First, they claim that key trading systems suddenly went offline, which just sucked all the liquidity out of the market, making it almost impossible to buy or sell. Then, right in the middle of the panic, margin requirements get jacked up, forcing people into selling whether they want to or not. On top of that, the biggest buyers of physical silver in Asia, they were all out of the office for a holiday. And the real kicker? This viewpoint claims that some major banks just happened to close out their massive short positions, their bets on the price falling, at the exact bottom. Talk about timing.
So you have to ask the question that the source poses, right? Are these 4 things, all happening on the day of a record-breaking crash, just an incredible string of coincidences? Or does it point to something that looks a lot more like coordination?
And to back up this idea of coordination, the source doesn't just look at that one chaotic day. It zooms out and points to what it calls a well-documented history of this exact kind of behavior from some of the biggest players in the game.
And this, right here, is what they say is the smoking gun. The entire argument pivots on this number, $920 million. That's the fine JP Morgan paid back in 2020 to settle charges that they had been manipulating the precious metals markets for years.
Now, when you dig into the actual details of that settlement, it's pretty wild. According to the U.S. Department of Justice, this wasn't just a few bad trades. We're talking about thousands of manipulative trades stretching over 8 years. It wasn't just silver either. It was gold, platinum, palladium, the whole shebang. And this wasn't just some slap on the wrist fine. No, the head of their precious metals desk and another top trader were convicted and actually went to prison. So the source says, look, there's a clear precedent for this.
Okay, so you might be wondering, how could a manipulation like this even be possible? Well, the explanation they give all comes down to what they see as a fundamental flaw, a deep vulnerability built right into the structure of the silver market itself.
The one key concept you got to wrap your head around is what's called the paper-to-physical ratio. It sounds complicated, but it's really not. It's just the massive difference between the number of paper claims on silver, like futures contracts, and the amount of real, actual, physical silver bars sitting in a vault somewhere.
And this chart really shows you what they're talking about. The video claims that for every single ounce of real physical silver that exists, there can be more than 300 ounces of paper silver being traded on exchanges. It's an insane imbalance. They call it the paper tail wagging the physical dog. So what's the point? The argument is that this gigantic paper market lets a small group with deep pockets totally overwhelm the system. They can dump a mountain of paper sell orders, create a panic, and crash the price on the screen, even if, in the real world, people are lining up to buy actual physical silver. And all of this leads to the source's conclusion. Based on everything they've laid out, they present their audience with what they frame as a very, very stark choice.
From their perspective, it's pretty black and white. On one side, you have the paper market, which they basically call a rigged game. It's subject to manipulation, your position can be wiped out by a margin call, and the price isn't even connected to reality. On the other side, they say, is owning the physical metal itself. That's how you get outside their system. It's a real, tangible asset that can't be force liquidated, and, they argue, it's your only protection from a paper market collapse.
And this quote really sums up their entire argument.
They don't see that crash as just another blip on the chart. They frame it as a deliberate message, a raw demonstration of power showing who's really in control of the market.
So that's the case laid out in the source material. It's a story that connects a documented history of manipulation with a series of very suspicious events to paint a picture of a coordinated financial attack. So that leaves the big question for you. Is this a plausible blueprint for how markets can be manipulated? Or is it just a compelling but ultimately unproven conspiracy theory? We report, you decide.